Hello, I'm Russ Mould, AJ Bell's Investment Director, and with me is Richard Penny, Manager of the Legal and General UK Alfa Trust and also a UK Special Situations Fund. Now, the funds cover the full range of UK companies, big cap right the way down to small cap. I think it's probably fair to say you're known for some expertise, particularly in the small cap space. Though we accept that, AJ Bell Youinvest, we know that a lot of you would rather pick your own stocks rather than pay Richard to do it for you. But he's kindly come in today to give us some pointers on small cap investing if you're thinking of doing it yourself. So, Richard, all those years of experience that you've got, when it comes to thinking about a small cap investment for your funds, what do you look for? Business model, financials, management acumen? What really, sort of floats your boat, as it were?
Okay, so I think perhaps the most important thing is to marry the valuation of the business against how you feel about it. Often, a business that intuitively you think is great, everybody else might have.
Well, we can all spot a good story, I guess.
Yeah,
can't we?
if we go back to 2000, all the internet stocks were brilliant, but they were massively overvalued. So
they were brilliant stories, but terrible investments.
However good you feel about the story, the valuation's got to be right. And the flip side to that is sometimes on a recovery situation, they might not be making any profits, having made tens of millions, but actually if you look inside them, there's assets there that are worth far more. So sometimes a badly performing business can make a great investment. So you have to think at the investment level.
So there's no golden bullet. There's no one size fits all here. It's very much a case by case basis. Do your own research seems to be the message.
It is do your own research, and you have to remember that if you're buying a share, somebody's selling it to you. So
you need to have a very good reason why, because you're effectively telling that other person they're wrong, right?
Yeah, but I think sometimes it is possible in the very smaller businesses that. Sometimes they are literally too small for the large institutions, and they will sell them because they've become too small. Okay. So I think private individuals can do proper research and gain an advantage that way. And I think a good way sometimes to do that is to follow the directors of companies. So they're closest to the situation where they're investing meaningful amounts of money.
So if they're putting money into the business, buying shares in their own company.
Yeah, they might buy £10,000 or £15,000 a year in an ISA, but if somebody's putting £100,000, £200,000 in and they're sitting on the board, they are.
You'd like to think that they
have a particular reason for doing it at the time they're doing it, and they're not allowed to deal if they know something that they shouldn't, but they obviously feel good about the business, probably on a 2 to 3 year view. I think that's always a good indication.
So you've obviously mentioned spotting a good story is important, a fundamentally well-run business or one that's got potential to be a better one. But then you mentioned valuation and making sure you pay the right price. So, we could talk about it all week, and I accept that we won't. But what sort of metrics or things do you look at when you're looking at valuation? Most people might be familiar with a PE, for example.
Yeah, a PE is a good starting point. It's where everybody starts, so know how everybody else is looking at it. PE just takes the profit after tax and works out how many times the price is of that. Gives you some kind of indication as to how long it would take you to make the purchase.
It's market cap divided by net profit, basically, yeah.
I mean, you do have to adjust that for debt, because you would end up with a very low PE with a company which had a huge amount of debt. And of course, if a company has a lot of debt, then you can lose all of it very quickly. So you need to look at that. On a recovery stock, you might look at the level of sales and where the company has traded at against its sales through the past. And that might lead you to conclude that something that's not making much money right now actually is actually cheap against where it's been in the past. But then if it's not trading well, again, you'd want to check that it has enough cash to survive. And I think one of the key lessons within small caps and AIM and these kind of lower end of the UK market is you need enough cash to survive through.
So balance sheet is very, very important.
Yeah, balance sheet is important, and that's for a trading business, but it's also for somebody with a business idea, be it a digital technology or biotechnology. They have a habit of taking longer and costing more, and if that company needs to come back to raise money, it will be at a fraction of the price. So this is really risky stuff.
So again, do your own research, particularly on the fundamentals of the business. Now, this is a matter for some people of serious debate. Do you ever look at a chart, or do you just strict at the technicals, as it were, or do you just stick to the fundamentals?
The fundamentals is the main driver. If I've got a position and I'm looking to sell it, then I know that everybody else use them, so I might run a position a bit longer just because I think that, I know there's other buyers, and charts can be an indication of that, but no, 90% of it is fundamental. We tend to trade in sizes and large amounts, unit size of millions of pounds, so we have to know what we want to do ourselves rather than second guess other people. For a smaller investor though, in small caps, it is useful to gauge what the institutions are doing. Because
it's kind of a synthesis of what the market's thinking, I suppose, now.
Yeah, but I mean, liquidity drives small caps. So if however cheap a share is, if you're buying it just as somebody's selling 10% out, one of the bigger life insurances or pension funds, you're not going to get a share price going up until they've sold the other 9% of it, and it's worthwhile understanding that.
Okay. And so, just without giving anything that could be misconstrued as financial advice, could you give us a previous example of a stock that's worked well for the fund, and what put you onto it? And we might even, by the miracles of television, be able to put the chart behind us.
Yeah, I mean, a stock I like is a stock that actually had done badly over the previous 5 years, but had been profitable, called Optimal Payments, and it's involved in payments for the e-commerce, online, and actually the gambling industry. It had been in North America, but that was deregulated.
A legal problem there, presumably.
Yeah, so the shares became cheap or lowly priced, but they weren't attractive to us until profitability started to recover. And we got involved roughly when the management were buying it. We paid a low price per pound of profits, but actually in 2011 when we got involved, there looked to be a really good recovery coming through and signing up more customers. So it was growth in sales driving profits, and there's actually a big drop through for every pound of sales into it. It's done far better than I imagined when we started. They have delivered several years now of really good growth. They've made some sensible acquisitions, albeit the organic growth has been the main thing. And people have been comfortable paying a higher amount of money as this was
their confidence has grown.
Well, it's become a more mainstream investment. I mean, at 70 or 80 million when we started it, there weren't many people that would look at it. That's quite small for institutions. But it's about to become fully listed. It was on the AIM market, and the market cap is up towards 2 billion now. So it's suddenly relevant to not only larger UK investors, but maybe North American investors who look at thematic internet type investing. So these businesses, as they get bigger, they tend to draw in a wider number of investors, institutional investors who will look at them.
Perfect. Thank you very much, Richard. That was very helpful. And thank you for watching, and we look forward to seeing you next time.
Thank you.